We're delighted to have Sidney Powell on the show today. Sidney is the CEO and co-founder of Maple Finance, the largest on-chain asset manager in the DeFi, decentralized finance sector, with over $4 billion in assets under management. Prior to Maple, Sid was the treasurer at Angle Finance in Melbourne and a banker at the National Australia Bank. Sid, thank you so much for joining us.
Thanks for having me on, Ty. Glad to be here.
This is I'm really happy we're doing this because the DeFi sector, a lot of our viewers, know a bit about it, but really, a great opportunity to talk to someone who's in the space. So for our viewers here who might not be that familiar with the DeFi space, can you explain in general terms what Maple does?
Yeah, for sure. Happy to. So the way I would explain Maple is we bill ourselves as an on-chain asset manager, but the core product we do is we lend to institutions. So we provide loans which are typically denominated in stablecoins. But the interesting thing we do, which is very particular and unusual to the crypto space, is that we take cryptocurrency as collateral. So a standard loan for us might be anywhere from 50 to 150 million in size to an institution who will post Bitcoin to serve as collateral for us to protect the loan position. And normally we would do a 70% loan to value ratio on that Bitcoin. So that's the core business, and then that generates yield that we provide to capital providers and investors on our side. And that ultimately comes from the interest on the loans to these institutional borrowers.
Wow, that's quite large. This is not sort of somebody who's starting, a new startup who needs $1 million or something. Or can they come to you for that as well?
Typically, that wouldn't be our sweet spot, Ty. But normally, the types of borrowers we would deal with are going to be corporate and institutional in nature, and it's a mix. It'll include prime brokers, large asset managers, market makers, miners. We've looked at some digital asset treasury companies, but these are typically larger institutions rather than retail borrowers. We're happy to do loans for earlier stage companies, but they just need to bring us collateral in the form of Bitcoin, ETH, Solana, or XRP. So we do try and cater to the larger cap crypto assets.
Are most of your borrowers, if you could characterize it, are they sort of the crypto based, DeFi based, or are they some sort of regular bricks and mortar businesses that just happen to have a fair amount of digital assets that they can pledge to get a loan?
It's a great question, Ty. It does tend to be more crypto based companies, so it'll be prime brokers who do a lot of trading activity or asset managers who have kind of a focus on crypto. However, we don't want to limit ourselves to just that one sector. So we'll also deal with family offices who might have just accumulated some crypto and they want to take out a loan to make a real estate investment, for example. Also, if we lend to mining companies, we would expect them to use the loans for wages, other operating expenses rather than just trading and investment. So we do try and have a little bit of a mix there, but it's predominantly crypto-based companies, I would say.
Fascinating. Family offices. I was just recently reading a term that may not, probably not new to you, but was new to me. It's don't sell your assets, buy, borrow, and die. So,
well, it's a very prudent concept for family offices. We have a few clients who've accumulated their wealth through holding crypto for a number of years. It might have been from early, the ETH ICO, or they might have discovered, Bitcoin 10 years ago. And what we find for these family offices is borrowing against their crypto holdings means that they don't incur taxable gains and they still retain the exposure to the future upside of Bitcoin, ETH, Solana, XRP. But we have found that is a typical reason that family offices come to us.
It's a great idea. If you're in it for the long term and you don't want to, imagine if you had sold some of your Google stock a few, 10 years ago to buy your house, you'd be like, my house didn't appreciate like Google. So now when you say it's sort of over collateralized, right? Now, because it's collateralized, are the interest rates very different based on the borrower's credit worthiness, or the fact that it's over collateralized sort of covers some of that?
It's a good question. I would say because it's over collateralized, what that means is that the interest rate between your lowest borrowing cost and your highest borrowing cost is much closer together than it would be for, say, personal lending or for small business lending. So the collateral gives us very good downside protection. Typically, if you were to give me $100 million worth of Bitcoin, we would do about a $70 million loan size. So we have a fairly healthy margin of protection. However, given we're dealing with institutions, the size varies quite significantly between the largest, who might have billions of dollars of equity, and the smallest, who might be a smaller family office or a high net worth individual. So we will price a little bit differently there, and that's just kind of the nature of the market. But generally, we've seen borrowing rates for Bitcoin-backed loans at the moment can range anywhere from sort of the 6 to 9% annualized.
Right. That's interesting. Good to know. Now, flipping to the other side of the ledger, so to speak, no pun intended, is if someone wanted to become a lender on Maple, is there sort of like a minimum commitment? Do we just does a lender look to deposit like USDC, something like that, and then essentially pick up that yield? Is it relatively basic?
Yeah. No, that's a fantastic question. So on the lender side, we actually have a much broader set of customers that we cater to. So you're absolutely right that a smaller lender, there is no real minimum amount that they need to deposit. So they can come to the platform if they're offshore from the US and deposit USDC. They will receive back a token that represents their share of the loans. And the interesting thing is that token is going to start accruing yield right away for that holder. So we have a number of offshore retail investors. We also have funds, corporate treasuries, asset managers who also deposit USDC, and then they instantly start receiving that yield. So that's been paying in the kind of historically, it's typically been between sort of 5 and 7% annualized. So they like it because it's beating T-bills, whilst also having pretty good downside protection from the Bitcoin collateral, as well as the fact that they can redeem it for cash at usually very short notice. Typically it gets serviced within the hour.
Wow. Wow, that is great. And for 5 to 7%, that's going to get quite a few people pretty excited. Especially if they're, they have, sort of, I guess, crypto holdings, and they want to, they want to get some yield out of it. If you're getting 2% on your checking account, or whatever percent in your checking account, maybe you ought to want to park something, like in something like Maple.
Yeah, well, I mean that's one of the exact sort of use cases that we have for on-chain allocators and investors. We don't market it necessarily as a replacement for a checking account, because ordinarily, as utilization picks up and as more people start taking out loans, there's going to be some duration on them. But what we've seen lately is that the product has scaled relatively quickly. So there's been fairly large liquidity buffers, and that's what's allowed us to do these kind of instant redemptions for people. But I've used the products myself. I think it's a fantastic way to get yield. And I think this is going to be a growing asset class. You just saw recently one of the Bitcoin lenders in the space, Ledin, has been going to market with an investment grade rated bond issuance. So I think you're only going to see more traditional allocators kind of come in and look to invest in the space.
I noticed that I did a little research, and I noticed that for a borrower there is a KYC process, which is great. I think you ought to know where you're lending your money, even though the money itself is secure. I think a lot of other folks don't necessarily do that in sort of the DeFi space. How long does your KYC process typically take?
It's a good question. I mean, if a borrower has all of the documents handy, you can do a KYC process within 1 to 2 days. Typically, what we would ask for is, if it's a corporate borrower, we need their articles of incorporation or memorandum of incorporation, the beneficial owners, register of directors, and declaration of the source of funds. We find that the actual longest period when we're onboarding a borrower is typically going to be the legal negotiation, because that's the other thing to know, Ty, is that all of our loans are full recourse. governed by enforceable loan agreements. So that's another point of difference from typical DeFi, where the loans are often non-recourse or they're not documented. We actually have contractual rights of enforcement for these borrowers that ensure that they meet their obligations, and that if anything goes wrong, we have the ability to to try and recover assets legally.
Great. So hopefully it's not as long as negotiating an ISDA.
Much shorter than with a bank. So I would say one of the ways that we have to win deals as a newer entrant into the space is that we try and win them on speed. So I remember there was a family office who wanted to borrow last year. They were introduced to us on a Friday, and then we had sent a term sheet and onboarded them by the Wednesday, and I think we had settled the first loan tranche by the Thursday. So that was inside of a week, and we can be that quick because we have the collateral backing the loan, so we can really rely on that. Whereas, if you were to go to a bank as a business borrower, good luck getting that done within 6 months.
Right. It would be like negotiating an ISDA between somebody who was particularly difficult, as we both were banks, right?
Yeah, exactly. It's not something. It's not a flippant comment. You and I have both worked in large banks before.
Yes. So I want to ask a little bit about the collateral, because that's interesting. And generally, especially since, in the past few months, weeks, we've seen some pretty sharp moves in the underlying collateral. Do those days make for some sort of very exciting, not in a good way, days for you? When I guess you're making margin calls and you're asking folks, listen, you need to pony something up, or otherwise we may have to do something we both would rather not do.
Yeah, it's a great question, Ty. I would say those days help keep us on our toes. They're not the most fun days when you're in the middle of them. But what we saw was a couple of weeks back on the Friday that was particularly volatile. So on those types of days, what we're doing is we're margin calling clients, and then once we margin call them, they have about 24 hours to either give us more Bitcoin to shore up the collateral, or they can choose to pay down their loan. Either way, we need to get back to the initial protected position that we were in. And then the other trigger or method of protection that we have is if the Bitcoin declines further, we have a stop loss level. So I was talking earlier in the conversation about our standard loan term would be 70% loan to value. So at 80% loan to value, that's when the customer gets 24 hours to post margin. And then at 85, that's when we take more aggressive action, and we would sell the collateral to implement a stop loss. So you can see we still have about a 15% buffer from the 85 to 100 before we would suffer $1 of loss. And at that stage, remember, we still have recourse to the customer's assets under the loan agreement. But I'll give you some numbers. So the other week, when we had all that volatility on the Friday, we did about 70 margin calls that week. Because our clients are institutional in nature, all of them were cured within about 2 to 3 hours. So very good, very responsive performance from our borrowers. We only had, I think it was one forced liquidation and one voluntary liquidation. So, from our standpoint, that's about as good a performance as you can hope for. And we've seen that in turn, over the past 18 months. So these volatile days will come up, 2-3 times a year. Every time the platform has functioned well, we've had no credit losses across our entire history. I think we've only had two liquidation sales to speak of. And so I think that's why this asset class is starting to find favor amongst investors, Ty.
That's quite remarkable how how well that was handled, because I certainly remember that Bitcoin goes under 60,000 for a nanosecond, and you give them 24 hours to cure it, and you turn around and the bid's fallen off the table, and it goes for exciting days that keeps you on your toes, but you don't want too many of them, huh? Makes life
you don't want too many. And I got to say, the other thing that we see in this space is that often those days, for whatever reason, we find they typically fall on Sundays. Asia comes online with their Monday morning. It's still Sunday afternoon in the US, and so you're doing frantic. You're doing these margin calls and reaching out to customers on a Sunday evening. So it definitely keeps you on your toes.
So one last question, getting a little bit into the weeds of this, but let's say I pledged 100,000, Bitcoin at 100,000, and I've taken 70% against, against it, for a loan. If the value of Bitcoin rallies to 125,000, does that mean that I can withdraw more of the loan because my collateral is bigger?
Yes, that's it. That's exactly right. So you have two options for our borrowers. Either they can refinance up the loan and take out a larger loan, or they can elect to withdraw some of the Bitcoin collateral. We can respond whichever way the customer prefers. We're happy to we're happy to extend a larger loan to them when their collateral is increased in value, or we can return some of that collateral to them.
Right. So if an investor, one of our viewers said, I may want to use Maple or put my funds with Maple, or I want to bet on the growth of Maple as a company. Is there any way to do that? Like, to invest in your enterprise rather than just be a lender.
Yeah. So what we have is the Syrup token. So this is the one governance token that kind of represents the entire Maple ecosystem. So Maple has never raised equity into an entity. There is only the token. And so any venture fund who's participated with us owns the token. Everyone on the team owns the token. And the token trades on Binance and Coinbase and a number of other global exchanges, including Upbit and Bthumb in Korea. So we treat the token as kind of ownership of the network. So all balance sheet, all assets, and all revenues really are for the benefit of token holders. At the moment, we do around a 25% buyback. So 25 for every dollar of revenue we get, we would spend 25 cents on buying back the token or contributing to the what we call a strategic reserve. And in any case, currently the protocol is profitable. So we're at about 32 mil annualized run rate revenue. We have budgeted expenses for kind of a mid-teens level. So we're one of the few DeFi protocols generating a profit. And our target for this year is to get to 100 million annualized recurring revenue.
Wow.
So all of that will be for the token holders.
That's a huge jump from 32 to 100 million.
Last year we did 8 to 9x revenue growth. So it's you gotta set lofty targets to keep everyone on the team on their toes.
Total value of the Syrup tokens is the market capitalization of the company?
Yes, effectively. Yeah. So currently I don't check the prices every day, but it would be around 300 million fully diluted valuation, but that's the right way to kind of think of the value of the enterprise.
Okay, so we could just go and buy Syrup on practically any major exchange, and then we would be a part owner, so to speak. And then those tokens, and so you're buying them back, with a part of revenue, which will raise the valuation there. So functionally, it's a stock if we want to think about it in a way that that you can, as the more money you make, the more valuable that stock will be. Does that translate well, sort of just like any other company that's listed? Generally speaking,
I'm comfortable giving some color. So unfortunately, because it's a token, you can't attach legal rights to it. So it's very important to note that there are not legal rights attached to owning the token in the same way that there would be if you were an equity owner in a company. And this is one of the things that needs to be worked out at a regulatory level. However, the way that I think of it is that as a token holder, you are a stakeholder in the business. In this case, we don't have other equity owners. And so we treat the token holders like those equity holders and like those equity stakeholders. They are partners in the growth of the business. And I think that the space has evolved now, and it's getting to a maturity where the way that investors are looking at tokens is they're now looking at them as kind of multiples. The valuation should in some way reflect a multiple of the earnings or the revenues of a business. So I think we are heading in that direction. And I think that businesses who can increase and grow their revenues, as we hope to do, that will drive value to token holders. The right metric I think of, Ty, is EPT, or earnings per token. The same way in equities land, you would look at earnings per share. That's what I think of as kind of the right way to value tokens.
Okay, it's really good to know. It's sometimes, those things, for at least a lot of people who grew up in traditional finance, you kind of don't think about it quite exactly right. So really, that was a very good, easy, simple way of describing it. Um, I want to move a little bit to sort of the more generalized crypto market. I think you predicted at some stage relatively recently that you had a price target of 150,000 to 180,000 for Bitcoin in 2026, and it's still remarkable that we hit an all-time high in October of 2025, and then here we are now, and regrettably, it looks like at least crypto Bitcoin has the negative beta in terms of, let me say that again.
Yeah.
It drops when stocks drop, and it doesn't really rally when stocks rally. So it's sort of what not the tail that you wanted. Do you still hold this view that we have some gas left we're still quite early in 2026. Do you see a crypto rally, and where's the source of that sort of rally going to come from? Because right now, I have to say that the sector looks a little beleaguered if you watch it every day.
Yeah, yeah. I think that's fair commentary. Look, it's felt tough. It's felt pretty brutal being a crypto investor. As you pointed out, when stocks rally, Bitcoin doesn't rally as much, and when stocks are down, Bitcoin's down worse. So we have this kind of almost negative convexity. I think, look, we're still very early in 2026. I think there was kind of a bit of a perfect storm where you had the new Fed chair perhaps being presented as more hawkish than people expected. At the same time, you had anxiety over the capex requirements for AI, compounded with the concept that AI was going to disrupt SaaS business models and really damage the prospects of that sector. And then also you saw that the Clarity Act was kind of delayed, and there was a bit of pessimism that might not get done this year. So I think we had a lot of compounding factors that combined and kind of led to the price action that we've seen. I think in the short term, I don't know that we've bottomed out. I could see it going lower. I could see Bitcoin going lower than where it is. However, I do still believe that over the course of 2026, I think we can have positive movement in Bitcoin. And I think we could see the year ending with Bitcoin, maybe not at the 150K target, but certainly closer to that, and maybe north of 100K, because I think we'll get some relief from the Fed over the course of the year. I think the concerns over AI capex commitments will settle because either projects will get canceled or those deals will get restructured. And I think the concern over SaaS revenues was kind of overblown. But it'll take another quarter or two to kind of see that come through. But I think that will help Bitcoin price.
Sort of a this too will pass kind of idea, where middle of last year, anything that touched AI was like magic. And now, as you mentioned, the SaaS issue, that anything that AI touches is going to collapse, and there's going to be nothing left. And that mentality is infectious both ways.
This is nothing new in the markets. We've seen it in the past. When Amazon got into a sector, staples or office supply company stock prices would take a hammering. But you find that, enterprise sales are very slow to shift gear, right? And so I think a lot of these SaaS companies, they have very long-term contracts locked in. These are sticky relationships. But also one other idiosyncratic risk I think that there is there's probably a lot of concern among RIAs around this quantum risk for Bitcoin. And that was probably preventing new buyers from coming into the market on the dip from the retail side. And so I think, this is also something that will get resolved. Obviously, everyone within the Bitcoin community and the Bitcoin core developers have every incentive to kind of solve that problem. But I think, again, that's another piece of news where maybe the fear index was a little bit worse than it should have been.
Clarity Act a little bit earlier, and there was great hope that certainly that this administration is a lot friendlier, and certainly this Congress is a lot friendlier than previous ones. But the Clarity Act's been sort of held up in part in the Senate, in part due to the sort of conflicting interests in the industry. Do you still think that this bill passes, that they're going to be able to deal with some of these issues like stablecoin interest restrictions that the TradFi guys really want to have in there, because they don't want to lose a lot of their deposit base, or a substantial amount of deposit base to guys like you? So what do you think about the Clarity Act? I mean, it's still early in the year, but the clock is kind of ticking.
Yeah, it's a good question. This has been the kind of the number one issue for everyone of late. I would say my own view and generally what I'm hearing from other sort of informed people in the market is that they think the Clarity Act is going to get done this year. It's likely to get done in the first half of the year, and that the key issue holding things up at the moment is, as you correctly pointed out, Ty, it is the rewards on stablecoin balances. So there's a dispute. Coinbase would like to pay rewards on stablecoin balances. Banks would like to prohibit rewards or yield from being paid on stablecoins because they don't want, what their argument is they want a level playing field. If you want to kind of pay yield out to people for just keeping their balances with you, you have to be more regulated like a bank, or otherwise it unfairly penalizes them. I don't know which way it's going to go. Obviously, the banking lobby is incredibly powerful, whilst at the same time, Coinbase has a lot of sway within the industry. And I think as somebody within the space, I probably skew towards thinking that rewards should be paid out because it naturally benefits the space, and I think it will benefit adoption. And also, I would say it increases more competition within the financial services sector. I think one of the problems is that the financial services sector has taken an increasingly large proportion of GDP as revenue, as its share, or rather its share of GDP has grown over the last few decades. And I think we need more competition introduced. And so I think that this is one way that
Mm-hmm.
competition can be brought about, and it gives consumers more options and ultimately, I think, more choice.
So that wouldn't impact Maple, right? If this did not pass.
Wouldn't necessarily. We're not a stablecoin issuer. The way I think of us is stablecoins are a foundational piece of technology. We are built on top of them. We provide a credit, fixed income, or lending and borrowing product, depending on how you want to class it, built on top of stablecoins. So we have relationships with Circle. We have relationships with Tether and with other stablecoin issuers. We think stablecoins are a fantastic technology. They're at about 300 billion outstanding circulating supply, and we think that's going to go to trillions over the next few years. But we don't want to be a stablecoin issuer ourselves. We just want to work with the stablecoin issuers. So no, it wouldn't affect us.
Right, right. That makes sense, and also suggests that a passage is probably priced into the market now, and if there's a spanner in the works, then the entire sector, the space could be, you'd have one of those tough days to weeks when
yeah yeah I'd hate to be I'd hate to be predicting that. I do. As I said, from most of my conversations, the base case expectation is that it gets passed, and it gets passed in the first half of the year. It really primarily seems to come down to this main issue on stablecoin rewards and yield.
Well, Sid, thank you so much for this conversation. Very illuminating. Thank you for being so absolutely clear and explaining how this whole thing works. I think I might go and buy some syrup myself. This is not I'm not telling all my viewers to buy syrup. It sounds like certainly at least as good a deal as some of the coins. Well, thank you so much once again, Sid.
Thanks for having me on, Ty. It was a pleasure.